What's up everyone, my name is Joris, welcome back to my finance channel. If you are already familiar with the FIRE movement, the Financially Independent Retire Early movement, you have probably already heard about the Boglehead investment philosophy. In this video we will talk about this specific philosophy and how to translate this rather American train of thoughts to our European strategies. For those who have no clue what the Boglehead investment philosophy is, it is a compilation of a few simple investment principles. When they are implemented, they have proven over time to achieve a far greater risk-adjusted return than the average investor. In other words, by implementing these 10 rules, you're getting a proven higher return for the same amount of risk you are taking. The Boglehead's investment philosophy is based on Nobel Prize winning financial economic research, such as the modern portfolio theory and the capital asset pricing model, or CAPM. Even though those individual theories seem extremely complicated at first glance, the Boglehead investment philosophy is rather simple. It is easy to understand and, more importantly, easy to implement. The idea of these principles is that successful investing is not a complicated process, and it can be accomplished by anyone with very little effort. Moreover, it is proven that the principles actually work. The original ideas of the investing principle came from Vanguard founder John Bogle and have further been explained and researched on the Boglehead forums by many others. The theory consists of 10 basic principles. Some are very easy and very quickly put in place, and others take more time and dedication. Some of the rules are very America-based and have little to no use here in Europe. Others are a lot more interesting in Europe, so stick to the end of the video to see what advantages we as European investors have across the pond. So let's get right into it. The first Boglehead's principle is to develop a workable plan. Experts call this financial planning. This first step is very important. If you don't have a foundation, you cannot start building your house. Likewise, if you don't have a plan, you are doomed to fail. And this is exactly what investing is. If you don't know what you're doing and you're just trying out some random things, you won't achieve anything. Before attempting to build your financial plan, it is a personal plan after all, you will need to establish a sound financial lifestyle. By setting up a household budget, you are pointing out your direct and indirect monthly costs, your savings towards bigger expenses, and you are planning for your long-term retirement. The key focuses here are to avoid bad debt. Debt for liabilities or other items that will only cost you money in the future. I made a video about this specific topic earlier and I will link it in the comments below. This bad debt will only keep you back, so make sure to get rid of this bad debt first and avoid it altogether in the future. Apart from debt management, you also need to manage your savings. A common mistake people make when saving is to save the money that is left at the end of the month. While this is a very good first step, it doesn't build any structure in your financial life, and your savings are linked to whatever you have spent that month. There is no incentive to watch your spending, since you will only save what is left at the end of the month. You will need to flip this idea around. At the start of your month, right when you receive your paycheck, you'll need to put aside a part of your income as savings, and you have to live the rest of the month with the rest of the money. This makes sure that you are saving a substantial amount every month and not just your leftovers, and you learn to live with a budget. This simple trick will show you how to live below your means, a trait that will prove to be very useful in the future. A direct result of this principle is that you will have a very good financial habit before you start earning more. I see a lot of people that start earning more and simply spend more, resulting in little to no extra savings. So what's really the point in earning more if it won't help you 5 years from now? I always explain this first step in detail since it is a very important one, and you should consider it very important too. After this step is in place, the rest is just implementing the theory and keeping at it. This step is the hardest and it is the most tedious. And of course it will make or break your financial journey. As Mark Twain once said, eat a live frog first thing in the morning, and nothing worse will happen to you the rest of the day. If this first task is done, the rest will become a lot easier. So the best way to tackle this first hurdle is to write the strategy down. It is as simple as that. Write down your income, write down your expenses, and then make a very vague financial plan. Make estimates, since you won't know every single detail from the start, and you can't know what major expenses lie ahead of you in the future. After a while, you will be able to adjust your plan and put in more details. At this point in time, it is better to have a vague plan rather than no plan. So don't waste your time trying to set up a perfect plan, but start out with a vague plan, because you won't be able to do so at the start anyway. There are too many variables. Just start doing it. Putting your plan in writing will give you the discipline to get things going and keep them going. The second principle is easy. Well, it depends. Invest early and often. People always underestimate the importance of time on your investments. You can't expect to invest every month for one single year and retire on that amount. But if you start early in your life and you invest consistently, the compound interest on your investments will make sure that your portfolio will grow exponentially over time. Once your first step is in place, your savings pattern is up and running. You can start accumulating your wealth. The Bogleheads investment philosophy proposes a savings rate of 20% of your income as a good starting point. But if your journey is shorter, if you are already a bit older, or if you want to retire before the age of 65, you will need to save more than that 20% of your income. On this figure, you can see the power of time on your investment plans. The best way to save consistently is to automate your savings. Most banks can set up an automatic savings plan where a preset amount of money is transferred to a savings or investment account of your choice. Every month when your paycheck comes in, a certain amount gets transferred. Use those plans so the savings are automatically gone and you don't see them anymore, so you won't be swayed to spend the money before putting it on the side. Most major banks also offer an automatic investment plan where your monthly savings are directly, immediately invested in funds. This type of automatic investment has many advantages, but they also have some disadvantages. We'll get to them later in the videos. So principle number 3, never bear too much or too little risk. The Bogleheads investment philosophy points out that the asset allocation of investments is very important. There should be a clear difference and clear-cut choices when setting up an investment portfolio. The major asset classes here are stocks and bonds. Owning stocks is necessary to pursue the return in the markets, to grow your portfolio and live off of it in the future. Stocks provide us with a share of the profits generated by publicly owned companies. They provide more potential return, but in turn they carry more underlying risk. They are more volatile, as they are called, and their prices can fluctuate a lot. Bonds, on the other hand, are needed to stabilize your portfolio, and they reduce the volatility or the movements of your portfolio. To find out how you should allocate your portfolio, you need to ask yourself what you should do when a major bear market hits your portfolio. What would you do if your portfolio loses 50% of its value, as we saw in 2008? Or more recently, what if your portfolio lost over 40% over the course of 2 weeks in March and April of 2020? On the long term, over the years, the overall stock prices will follow the worldwide economy, whose tendency is to grow. But of course, individual stock prices can stagnate or even decline for years before recovering. This is a risk you need to be willing to accept, and you need to guess how it would influence you at the time of a bear market. The Bogleheads suggest to add bonds to your portfolio to reduce the volatility of that portfolio. The more risk you are willing to take, the less bonds you should add to your portfolio. In his book Common Sense on Mutual Funds, John Bogle advises that As we age, we usually have more wealth to protect. We have less time to recoup severe losses, we have a greater need for income, and perhaps an increased nervousness as markets jump around. All four of these factors suggest more bonds as we age. And this is where investing in Europe is severely different from investing in the United States. In the USA, all profits on investments in stocks is taxed, while dividends from stocks and bonds are not. Here in Belgium, it's the other way around. No taxes on capital gains, but there are major taxes on dividends from stocks and bonds. This specific difference, together with the lacking returns on European bonds, questions the use of bonds in Europe altogether. The Bogleheads suggest bond funds to ease the investments in that asset class. But European bond funds often have no or even negative returns, especially now with our extreme low interest rates. Since there are no real European alternatives for bonds, it might just be better to keep a part of your portfolio in cash. You can also take more risk in your bond portfolio just to get a little bit more return, but that would be counterproductive. The Bogleheads suggest a rule of thumb to take your age and invest that part of your portfolio in bonds. For example, if you're 30, invest 30% of your portfolio in bonds. But since taxes in Europe work differently, there is no use in following this specific rule. It is better to keep a larger portion of your investments in stocks and keep ample cash on the sidelines. Again, look at your stance towards risk in your portfolio and adjust that allocation. A fourth principle is to diversify. This is a very important one. Don't put all your eggs in one basket. Don't bet all on 23 red. Instead of investing in a select few companies and buying their specific stocks, just buy the whole market. You will get the average return of the whole market with limited risk. Diversification goes further than stocks though. Adding bonds to your portfolio will add to your diversification. Adding commodities, adding real estate, art or other assets all help in the long term. The key takeaway here is to invest as broad and as diversified as possible and don't spend any time updating your portfolio. Just stick to the original plan. Directly following this statement comes principle number 5. Never try to time the market. As you are invested in the broad market, you don't need to spend your time looking for the best companies that might outperform the market in the long term. Just stick with the whole market. And the same goes for trying to time the market. There will always be good news and there will always be bad news on the markets, convincing you to not invest just yet and wait for the next dip. Buying yesterday's winners and letting your emotions take over makes sure that you are buying high and selling low. Timing the market is next to impossible. You're always too late when you're selling and you're always too late when you're buying. And if you miss a handful of good days on the market, your return will suffer immensely. As we said in principle number 1, set up your financial plan and stick with it. Once the plan is in place, it is super easy to keep it on track. Don't make it more difficult for yourself. To keep the video bite-sized, I will divide this video in 2 parts. So next video we will handle principles 6 through 10 and we will have more useful tips to get your financial journey well on track. Don't forget to subscribe to the channel and hit the notification bell so you won't miss the release of the next video of part 2 of this video. I would also appreciate it a lot if you like this video. A simple act helps the channel a lot to grow and reach more people. I thank you very much for watching and I will see you in part 2.